In this lecture, lecture 8, we're going to start a new chapter, which is chapter 14. Is the long-term liabilities. So we are continuing to discuss the classified balance sheet, in which we classified the liabilities into short-term and long-term liabilities. We already discussed the short-term on lecture 7. Now we are going to start to discuss the long-term liabilities in this chapter. In today's lecture, we are going to discuss the following objectives. We are going to discuss the first type of long-term liabilities, which is a bond. We are going to identify different terminologies related to bond and how we are going to account for bond transactions, including how we record issuance of bonds at par, at discount, at premium, and how we record interest expense on bonds, and how we record retirements of bonds at the maturity date. Before we go deep into the chapter, let me first differentiate between the short-term liabilities that we discussed in chapter 11, which is current liability, and the long-term liabilities that we are going to discuss in this chapter. The current liabilities or the short-term liabilities, those are obligations, future obligations that is expected to be due maximum within 1 year. However, the long-term liabilities are future obligations as well. However, they are expected to be due. They will be paid for a period of more than 1 year. So in this part, in this chapter, we are going to discuss those long-term liabilities. We will classify the long-term liabilities into 3 types, as you can see. The first type represents the bonds, the second type represents the long-term notes payable, and the third type represents pensions and leases. In this lecture, we are going to focus mainly on bonds and part of the long-term notes payable. So, let's start now by defining what is bonds and discussing some related terminologies in order to understand what do we mean by bonds. So, if we are talking about a company, a large company, and this large company needs large amount of money to finance their operations, how can they borrow money? They may have to take long-term loans from banks or to issue bonds payable to the public to raise the money. If they are going to take long-term loans, then the company will depend on externals to finance this company, and this we're going to call debt. In this case, the company will be in debt to the banks. Also, the company in this case has another situation, which is to borrow from the public, to borrow from the people, the normal people. If this is the case, then the company will issue something to the public called bonds. This is another way for the company to raise money in order to be used in financing its operations. So bonds, let me say it in Arabic, bonds اللي هي يا جماعة السندات الحكومية. So one of the famous bonds that we had in Egypt during the last maybe 3 or 4 years was قناة السويس bonds that was used by the government to finance building of the new Suez Canal at that time. So what happened at that time? Government needed money in order to be able to finance this major project. So the government started to issue bonds to the people in order to borrow from them money and will take this money to finance its operation. And then at a certain date, after 3 years of that, the government repaid back those money to the public, to the people, plus semi-annual interest paid during the periods of the bonds. So, bonds payable, we can define it now as long-term debts issued to multiple lenders called bondholders. So people who will buy the bonds, we will call them bondholders. For example, a company could borrow $100,000 from one lender, the bank, or it could issue 100 bonds payable, each at a cost of 1,000, to 100 different lenders. So, company can borrow from one person or from multiple persons, and usually it will be the case of multiple lenders. So, by issuing bonds payable, companies can borrow millions of dollars from thousands of investors rather than depending on a loan from one single bank or lender. So each investor can buy a specified amount of the company's bonds. So each bondholder gets a bond certificate, like the one that's disclosed in front of you now. This bond certificate shows the name of the company that borrowed the money. The case that we have here is Qanat Suez company. This is the company that borrowed the money, which represent the government. Exactly like a note payable. The certificate states the face value, which is the amount of the bond issue. So we have here the bond face value. This represents the amount of money that the company will borrow from the public. In case that we have here, I don't know if you can see it, here we have إجمالي مبلغ الشهادات 3000. So this is the face value that we have here. Also, we call it face value or bar value or principal value. Okay, then the company must then pay cash, pay each bondholder the face value amount at a specific future date called the maturity date. So the maturity date here represents the date on which the company should repay back the principal amount. So here we have on the slide تاريخ الاستحقاق 7th of September 2019. So this represents the maturity date. So people usually buy or invest their money in bonds for a certain reason, which is to gain interest. So interest here represents revenues for the people. However, it represents expense for the company. So the bond certificate states the interest rate that the company will pay and the date the interest is due. So here, if you can apply it, can you see 12%? This is سعر العقد السنوي 12%. This is the interest rate. And it's annual, so the interest rate will be paid annually. So, again to stress what we have been discussing in the last slide, the company that needs money will issue bond certificate to the people, which are here the investors. So the company or the corporation will be the seller. So it will offer the bonds in the market with a certain selling price. And the investors or the people, they will be the buyers who will buy the bond from the company and they will get bond certificate. And then during the life of the bond, the company will have to make interest payment to the investors. So interest will represent from the company point of view expense, while it will represent from the investor's point of view revenue. So this interest will be paid during the life of the bond. So it could be paid monthly. So the company can pay monthly interest expense for the investors, or every 3 months, which is quarterly, or semi-annually, which is every 6 months, or annually every 12 months. So the interest is calculated by applying the rule that you have here, which is the face value of the bond, the bar value, times the stated interest rate, the coupon rate, times the period. And then at the end of its lifetime, which is the maturity date, the company is obligated to repay back the principal amount borrowed to the investors. And this is what do we call retirement of bonds at maturity date. Let us now discuss the advantages and disadvantages of financing through issuance of bonds. Let me start by discussing the disadvantage. Issuing bonds means that the company will go for externals in order to finance its operations. So it's a form of a debt. So debts must be paid during unprofitable years as well as profitable years. So a company who went for issuance of the bond might not have enough cash flow to make the interest payment. Therefore, the company will default on the debt. So, without the cash necessary to make the interest payment, the company could have to declare bankruptcy. So, the only disadvantage of financing through bond is that the company may not be able to repay back the interest and the bar value at the maturity date because the company could have been unprofitable. Accordingly, it will not have enough money to repay back its debt. So this is the disadvantage, and this could lead the company to be bankrupted. However, also, when you're going to use bond as a source of financing, it has two advantages to the company. The first one is that debt is a less expensive source of capital for the company, and bonds will not affect the percentage of ownership of the corporation. So, when you're going to go for externals to borrow money, you're going to be in debt for those externals. However, they will not be owners in your company. So, bonds financing will not affect ownership control. This is in contrast to other sources of financing, as we are going to discuss during the coming chapter, that we have another source of financing is through issuance of stocks. When the company will go for stocks, this means that the ownership percentage of the company will change. You're going to bring others who will be owners beside you. So the ownership percentage will change in the company. This is if you're going to finance using stocks. However, if you're going to finance your company using bonds, the ownership control over the company will not change. So this is one of the advantages. You're going only to borrow money and you're going to repay back that money and the interest at a later date. So the others, the externals, will not be owners in the company. The second thing is the interest that you're going to pay on the bonds, which is the interest expense. The company will record this as part of its expenses. And as you know, whenever expenses increases, income decreases. And when income decreases, the company will pay lower taxes because taxes are collected on the income. So this is the second advantage of bond financing, is that interest on bonds is tax deductible. The meaning of tax deductible is that the company will record the interest expense paid on the bond as part of its interest, as part of its expenses. So this will increase the amount of its expenses. Increasing the expenses amount will decrease the income because we have a negative relationship between income and expense. And when net income decrease, the company will have to pay lower taxes on the income, and this is an advantage of bond financing. So, if I am a normal person and I want to invest my money through buying bonds, from where can I get bonds? If I want to get bonds, then I have to go to the stock market in order to get bonds to myself and to invest my money. So, if you're going to go to the stock market, you need to know how to read the information that is related to the bonds that's traded in the stock market. As you can see here, we have in the front of you, let me highlight it for you. You have those information that is related to a certain type of bond. Let me illustrate it for you what these numbers means. IBM stands for the company name. So the company that is issued those types of bond is the IBM. So IBM is the issuer name. This is the company that will borrow money from the public. So rate, this is the coupon interest rate. So when you're going to borrow money from IBM through buying their bonds, IBM is obligated to pay for you 4% interest rate. So this is what you call contract or bonds or coupon interest rate. MAT or maturity 42, this means that this bond will mature in year 2042. This is the date on which the principal amount borrowed will be repaid back. Yield represents 3.81%. This is the current market value or current market rate of the bond. So if I want to trade this bond in the market, it will yield 3.81%. Volume, this means that the daily traded number of bonds related to the IBM equal to $110,000. This is the value of bonds traded in the market. Close, this is the closing price for the day as percentage of par value, because usually in the stock market those bonds are traded each day. So each day the prices of the bonds will change. So at the end of each day, each bond will be priced by a different price, different from the previous day. So on that date, the closing price of the IBM bonds was 103.08. And this indicates percentage of change of 0.73% increase in its closing price compared to the previous day. So let us now discuss the first learning objective after we discussed important terminologies related to bonds. We need now to know how to prepare journal entry to account for the bond issuance and the payment of interest expense related to that bond. So let's take this exercise. On December 31st, 2017, a company issued the following bonds. Bar value equal to 100,000, and please take care that bar value can also be called principal value or face value. So this is the amount of money that the company will borrow, which is $100,000. The stated interest rate, it's also called coupon interest rate, is 8%. Interest dates will be end of June and end of December. This means 2 times per year. This means that the interest is paid semi-annually. The maturity date is after 2 years, which is on December 31st, 2019. Now we need to record a journal entry to reflect the issuance of the bond. So the issuance of the bond took place on December 31st, 2017. So what happened? The company issued the bonds to the public, and in return will receive 100,000. So this 100,000 represent increase in the cash of the company. So company will debit cash to indicate an increase in the cash of the company by 100,000. In return, this 100,000 represent future obligation to the company, because the company after 2 years will have to repay back those 100,000 to the bondholder. That's why the company will credit bonds payable. Bonds payable here is a liability account, and as you know, liabilities, they increase in the credit side. Now, on June 30, 2018, the issuer of the bond pays the first semi-annual interest payment of 4,000. So, after the first 6 months, the company is obligated to start to pay interest to the bondholder. How can we calculate interest? The rule is to multiply the principal value of the bond, or the face value, which is $100,000 given, times the given interest rate in the exercise, which was 8%, times the period. The period here indicates the date on which we are going to pay the interest. Here we are going to pay interest on June 30. So we need to calculate starting from the date of issuance, which is on Jan 1st till June 30. So this indicates 6 months or half of the year. So when we are going to calculate it, we will get 4,000. So this means that the company will have to pay 4,000 bond interest expense. So on June 30, the company will need to record bond interest expense. So it will debit the bond interest expense to indicate increase in the expenses, and it will pay this in a form of a cash. So cash of the company will decrease, so the company will have to credit cash. This journal entry will be repeated every 6 months until the maturity date, because every 6 months the company is obligated to pay this interest to the bondholder. So we will have the same entry repeated by the same amount every 6 months. Now we need to know at the maturity date, what will be the journal entry? So after 2 years, on December 31st, 2019, the bonds mature, means it reached to the maturity date, the end of its lifetime. And the issuer of the bond pays face value of 100,000 to the bondholders. Now the company will repay back the $100,000. So its liability will decrease. The company will be no longer liable to the bondholder. So the company will debit the liability because liability will decrease. So it will put it in the debit side by $100,000. So the company will record bonds payable as debit by 100,000, and it will pay, so it represents cash out. So the cash of the company will decrease, so the company will credit the cash. So the retirement entry or the payment entry of the principal value of the bond is always, we are going to debit the liability to indicate decrease in the liability of the company, and we are going to credit cash to indicate decrease in the cash balance of the company. So let's discuss this exercise, which is more related to what we have been explaining. A company issues 8% 2-year bonds on December 31st, 20x1 with a par value of $7,000 and semi-annual interest payment. So now we have 8%. Let us analyze the numbers that we have. 8% here, it indicates the interest rate. So we call it coupon interest rate, the interest rate that is written on the bond certificate. 2 year, it indicates that the maturity of the bond will be after 2 years. And the issuance was on December 31st, 20x1 with a par value of 7,000. This 7,000 represents the par value. It could also be called face value or principal value. And semi-annual interest payment. Semi-annual means it will be done 2 times per year. On the issue date, the annual market rate for these bonds is 8%, which implies a selling price of 7,000. This indicates that the value of the bond on the market equal to its coupon interest rate. So if I am an investor and I want to invest my money not in buying those bonds, but in buying any other bond. Any other bond will also give me 8%. So this means that this bond is traded at the same rate prevailing in the market. So this means that it will be sold for 7,000. So you are required, number 1, to prepare journal entries to record the issuance of the bonds on December 31st, 20x1. So when I'm going to issue bonds, I will receive cash, so my cash will increase. The cash value will equal to the selling price, which is here 7,000. In return, the company will be in obligation to the public. So this means that the company will be liable to the public. So this will make the liabilities of the company increase. So the company will record this as debit, cash equal to the selling price, which is 7,000. And increase in its liability, so it will credit its bonds payable by the same amount, 7,000. So that was the first journal entry. Then we need to record the first through fourth interest payment on each June 30 and December 31st. So now we said that the company will have to make semi-annual interest payment to the bondholders. So semi-annual means every 2 times per year, so every 6 months. So for how long? For 2 years. So this means 4 times. Each year we'll have to make 2 payments. So we have 2 years. This means 4 payments throughout the whole life of the bond. So the entry that we will need to record will reflect each semi-annual interest payment. So the entry will be debit interest expense and credit cash. How can we calculate the interest expense amount? We should multiply the principal value, the 7,000, times the coupon interest rate, which is the 8%, times half of a year. So every 6 months, we will record this entry, debit bond interest expense by 7,000. This is the principal value or the face value or the bar value, like that, to make things clear, times the coupon interest rate, which is 8%, this one, times semi-annual, so this means 2 times per year. So we will get 280. So every 6 months, the company will pay $280 as an interest. And this will be in a form of a cash, so cash of the company will decrease. So the last requirement is you need to record the maturity of the bond. Maturity means that the life of the bond came to an end. So at the end of its lifetime, the company will have to repay back the principal amount. So cash of the company will decrease and its liability will also decrease. So we are going to record reversing the first entry, the first issuance entry. So the first issuance entry was debit cash, no cash will be credit. And it was credit bonds payable, now bonds payable will be debit. So we are going to reverse it. Like that. So that was the first requirement. Second requirement, how much is the prevailing market interest rate? So in the market now, if I want to invest my money in another bond, what will be the interest rate that I will get? It's given that the annual interest rate in the market is 8%. So it is 8%. And how much is the coupon interest rate? Coupon means the interest rate of the bond, of the certificate of the bond. So it's mentioned to be 8%. So the same of the market. This means that when the market interest rate equal to the coupon interest rate, this indicates that the bonds are being sold at par value or at 100% of its value, because sometimes the bond can be traded in the market at a value below than its par value. In this case, we will treat bonds to be sold at a discount. Or sometimes, in other situations, bonds can be traded at a price above than its par value. So we will call this that the bond is traded at a value above its par value, so we call it traded at premium. Those two cases we are going to discuss in the next slide, how we record bonds when it's traded at discount and how we record bonds when it is traded at premium. So let us now discuss the three cases of bond issuance. Bond can be sold at par value, at a value equal to the par value. In this case, the contract rate should equal to the market rate, or the bond could be sold at a value above its par value. So this would be called selling bonds at premium. So this takes place when the contract rate is higher than the market rate. Or the bond can be sold at a price below its par value. In this case, bond is said to be sold at discount. This takes place when the contract rate is less than the market rate. So let us now discuss the one of those cases, which is how we deal with bonds issued at discount. So a bond is issued at discount when it is sold for a price less than its par value. So let's take here the example that we have. FILA issues bonds with the following provision: bar value $100,000. Bar value, this is the face value, the principal amount that the company will borrow from the investor, and should be repaying that amount at the maturity date. However, in this case, the issuance price is 96% 0.45 of the bar value. This means that the selling price of this bond will be below the bar value. Why this takes place? So, a bond is issued at a discount when it is sold for a value less than its bar value, as the case that we have here. When the interest rate stated on the bond, here the interest rate that is stated on the bond is 8%, is lower than the market interest rate. Here the market interest rate is 10%. Then the bond will be sold at discount. This takes place because when the interest rate stated on the bond is lower than the market interest rate, the investor considers that the bond will be recorded at bar, which is 100,000, less the discount on bonds payable, which is 3,546. So we will get the carrying value, or the real value of the bond, which is 96,454. So discount on bonds payable is used to reduce the carrying value of the bonds. So this is the case of bond issuance at a value below its bar value, or issued at discount. So let us now discuss the case of issuance of bond at a price above its bar value, or what do we call issuance of bonds at premium. So we have a company that's called Adidas that decides to issue bonds with the following conditions: its bar value equal to 100,000, its issuance price will be above the 100% or the bar value, which is equal to 103.546%. The stated interest rate, or the coupon interest rate, or the interest rate that this bond will be offering to its bondholders, is 12%, while the prevailing market interest rate is only 10%. And we have interest dates every 6 months, and then the maturity date will be after 2 years. So now, what happened is the stated interest rate on the bond, which here is the 12%, is higher than the prevailing market price, which is 10%. So now the company is able to sell its bond for more than their bar value. So when it will sell this bond in the market, it will not receive the bar value amount, which is 100,000. No, it will receive a value above than the bar value. That's because it will offer interest rate more than the prevailing interest rate. So investors will buy this bond because they consider the bond to be worth more than its bar value, because it's offering a rate of return that is higher than the market rate of return. So now investors will be motivated to buy this bond and will agree to pay for it using higher price than the bar value, because its real value in the market is more than the market interest rate. It's worth 12%, while any similar bond in the market is only worth 10%. Okay, to illustrate a bond premium, assume that the market interest rate that is offered by Adidas company on its bonds is 10%, while the company will issue bonds with 12% return or interest. So these 12% bonds of Adidas company are very attractive in the market, because the market offers interest rate on any other bond only equal to 10%. So this means that this company, Adidas company, offers rate of return, or it will pay interest expense equal to 12%, while any other bond in the market will only pay interest expense 10%. So these bonds are very attractive in the market. So this will make the investors in the market think that this is a very good chance to invest their money in, because they will get more interest if
they want to invest their money in this company compared to any other bond. So this will make the investors pay extra money to acquire them. So we will call this bonds will be sold at a premium. So exactly here what will happen, those bonds will be sold in the market at a price which we call it issue price equal to 103.546% of bar value, which means more than the bar value. It will be sold for a price, for a selling price, which we call it issue price, more than the bar value. So in this case, the company will receive cash not equal to the bar value, not equal to the 100,000, but above the bar value, which will equal to $103,546. This will be cash received upon issuance. So if the company now would like to record this, then the company will make this journal entry. It will record the cash received. Cash received here is the selling price, which we call it issue price. So how can we calculate it? We multiply the 103.546% times the bar value times the $100,000. So we will get the issuing price. We said that here that the issuing price or the cash that the company will receive will be higher than the bar value because those bonds are sold at premium. Why it's sold at premium? Because it offers interest rate 12% higher than the market interest rate, which is only 10%. So this is something attractive for the investors. So investors are motivated to pay higher price for those bonds. Then on the other side, the company will record the liability that is created because after the end of the life of these bonds, the company, Adidas company, will have to repay back the face value. The company will repay the face value, not the issuing price, not the cash received. So the company will credit bonds payable to increase its liability by 100,000. Remember that every time we record bonds payable, we should record it with the bar value. So here it will equal 200,000. Then the difference between the cash received and the liability created, which is 103,546 and 100,000, represent 3,546. This 3,546 we are going to record in an account called premium on bonds payable, as you can see here. So this premium on bonds payable, we call it adjunct account. Adjunct mean associated to the account, to the original account, which is bonds payable. Bonds payable account and premium on bonds payable both have a credit balance. So this is its nature is credit balance. So what is adjunct account? This is an account that is directly related to another account. Adjunct accounts have the same normal balance as the related account and they are added to the related account on the balance sheet. So when we want to make a balance sheet presentation of the bonds payable, we will see that here bonds payable will be recorded at the balance sheet at its bar value, which is $100,000. Then we are going to add to it premium on bonds payable amount, which is the 3,546. This will get us the carrying value of the bond equal to 103,546,000. So now what we did, we added the premium to the bonds payable to reflect its real value in the market. So we calculated carrying amount of the bonds payable. So again, the premium on bonds payable is adjunct or associated account to bonds payable, and it have a normal balance as the related account, and they are added to the bonds payable on the balance sheet. So adjunct account work similarly to contra account. If you remember the contra account, the one we have discussed, a discount on bonds payable case, the one that we had been discussing when we discussed bonds sold at discount. The only difference between the adjunct account and the premium account is that adjunct account has the same type of balance as the main account, whereas the contra account has the opposite type of balance of its main account. So here we are going to add the premium on bonds payable to bonds payable to determine the bonds carrying amount as we did here. So the bonds carrying amount will be 103,546. So let us solve a more exercise on the bond issuance at bar, at discount, at premium. By referring to this exercise, a company issues 8% 2-year bonds on December 31st, 20x1 with a bar value of $7,000 and semi-annual interest payments. On that date, on the issuance date, the annual market rate for those bonds is 8%, which implies a selling price of $7,000. So now please be aware that the selling price is $7,000, which is equal to the bar value. Why is that? Because this bond offers 8% interest rate, which is equal to the market interest rate, which is also 8%. So this will make the bond sold at bar, sold at a value equal to the bar value. Now we are going to change this condition by referring to requirement 5. Let us see requirement 5. Prepare the journal entry for issuance assuming the bonds are issued at, first case, $98 per bond. This is the selling price or the issuance price, which represents 98% of its bar value. So this means that the bond will be sold at a price below its bar value. We will treat bar value as equal to 100%. So when we say 98%, this means below the bar value, below than 100%. So why the company will sell bonds at a price below its bar value? This for sure, because this bond will be giving an interest rate below the interest rate of the market. So in order to motivate investors to come and buy those bonds, although those bonds offer interest rate below the market interest rate, we will have to reduce its selling price. So this means that the bond is issued at discount. So in order to prepare a journal entry to record this, we will record the cash received. Cash received is equal to the selling price. And we need to record the liability created for the company. Liability created was equal to the bar value. So we will credit bonds payable. Again, always remember, we record bonds payable with the bar value because after 2 years, after the end of the life of the bond, the company will return to the investor the bar value, the 7,000. So it will not return the issuing price. So we will create a credit bonds payable to indicate the increase in the liability of the company by 7,000. On the other hand, we need to debit the cash received. The company received the issuing price. What was the issuing price? 98% of its bar value. So we will calculate it by multiplying $7,000, the bar value, times 98%. This means 6,860. So the company will not receive the bar value, but will receive the issuing price, the cash. So now we have a difference between the debit side and the credit side. This difference represents discount on bonds payable. So we record it in the debit side to make the total debit side equal to the total credit side. So this difference is 140. Remember, we said that discount on bonds payable is a contra liability account. So it will be reduced from the bonds payable when we do the balance sheet. So that was the first case. In the second case, we are going to assume that the bonds are sold at $102 per bond, or 102% of its bar value. So this time, the company will sell the bonds at a value above its bar value. The selling price will be above the bar value. Why the company will do that? Because for sure, this means that the company will offer an interest rate on the bond higher than the interest rate that is in the market. So this will make the investor motivated to go and pay more to get those bonds, because this will be a very good opportunity for them to invest their money, because they're going to invest in their money in a bond and will receive interest rate higher than the one that is in the market. So the cash received will be above the bar value. So this means that these bonds are issued at premium. So let's record the entry, the issuance entry. Again, the company will create a liability by the bar value, because after 2 years, the company will repay the bar value. So we will record credit 7,000. Now we need to record the cash received. Cash received will be debit because the cash in increased. So how to multiply it? We will multiply the bar value is the 7,000 times the 102%, the issuance price. So this means that the company will receive not 7,000, but will receive a higher price for those bonds, which is equal to 7,140. The difference, 140, we will have to put it in the credit side in order to make total debit equal to total credit. So we were going to call it premium on bonds payable. Premium on bonds payable, we agreed that we're going to call it a junket account. So it will be added to the bonds payable when we do the balance sheet. So that was related to requirement 5. Now let's do requirement 6. This is complete. So when bonds are being issued at discount, this means that the coupon interest rate or the interest rate offered by the company on the bond is for sure will be lower than the market interest rate. That's why I will have to reduce the price of the bond in order to make investors come and buy it. Otherwise, they will not buy it. So B, when bonds are being issued at premium, this means that the coupon interest rate is for sure higher than the market interest rate because I'm giving the investors more money than any other bond in the market. So I have the right as a company to raise the selling price of my bonds. So this is called bonds issued at premium. By that, we have came to the end of lecture 8. Thank you.